Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to continue on taking your stock recommendations, and today we're going to be analyzing the company Ally Financials, which was actually brought up by Gerald Schmidt around 6 days ago. We pretty much just said, good job, what about analyzing Ally Financial? Thanks. So let's actually take a look at this company guys and see if with the current collapse of the entire US stock market, is it a buy? And well, stick around because there's some pretty interesting stuff about this company that, well, let's just say it might take my #1 spot when it comes to the financials. So with that said, let's get started with this analysis. We're going to jump into the dividend summary guys. This company does pay out a dividend of a whopping 4.02%, which ends up being 30 cents per share for an annual payout of $1.20. A very low payout ratio of 13.8%. Now remember, when it comes to financials guys, some financials actually do have capital expenditures. However, it is just best to use book value. So for this analysis, we're going to be using guys book value and tangible book value, since those are the best two methods to analyzing financial companies. So payout ratio of 13.8% is the best that we got to look at when it comes to a payout ratio, which is actually very, very good. A 5-year CAGR, guys, of take a look at this, 26.15%. I'm gonna stop, give everybody a pause. Let's say that one more time. 26.15%. Dear Lord. And on top of that, they have had 5 years of consecutive dividend growth, which is also amazing to see. Ex-dividend date guys actually passed as of July 29th. Payout date was August 15th, and they pay their dividends quarterly. So now let's come into the spreadsheet to analyze this company a little bit further. We got the ticker symbol of Ally, ALLY, market cap of $8.8 billion with, look at this PE guys, 4.02. Oh my god. This means that with a current share price of $28.51, this is looking like an amazing price to buy it at. Now, let's actually go further into this guys, because as everybody noticed, the market has just been in complete collapse and it's looking beautiful now. It's getting to the point where I am like, okay, companies are just falling into like their fair value now, and this is way too many to pick now. So hopefully y'all saved up cash, because specifically looking at this company guys, just today they fell 4.5% on the day, and even post-market they fell another 0.07%. Looking at this graph guys, on the 1 year they are down 46.83%, almost half, and looking at the year to date they are down 41.31%. That is insane. And looking at this 52-week range guys, we are there. We are essentially what, 11 cents off from the 52-week low, which is just absolutely insane. This is just screaming value right off the bat, or at least the fact that it is at a 52-week low, it is starting to look like it is a screaming value. But let's actually use now book value and tangible book value to come up with a better assessment as to what this company should be worth. Now, looking at the annual dividends per share, guys, they currently pay $375 million in dividends every single year based off of their shares outstanding, which actually isn't much. Now let's start off with some fundamentals, of course, with the net income. Guys, we got 5 years ago of $929 million to today of, look at this, $2.5 billion. That is a massive increase of 169%. And we do see a little bit of a hiccup here 2 years ago, guys, but honestly, we all know what happened 2 years ago. It's perfectly fine. I'm going to take it as an outlier. The main issue that I have here is that, well, if we ignore the 2-year value and we take the 3 and the 1-year value, there's a pretty big jump from $1.7 billion to $3 billion. But then again, inflation hit, right? Usually when inflation hits, financial companies tend to do really good. Not so much because this value looks bigger, it's just because of the fact that the dollar value went down. Therefore, they need a lot more dollars in order to subsidize that same value that they had before. So that's essentially why you see this massive jump. I still don't necessarily like it though. And as of today, they're at $2.5 billion. And this year, guys, for them isn't even over yet. They end in December. So with all of this said, guys, I'm actually going to give this a fairly good score at around like 85%. Looking now at the total revenue, we got 5 years ago of $5.86 billion to today of $8.5 billion, increase of 44%. And you can see a very nice consistent increase from 5 to 3 years ago, small dip 2 years ago, COVID related, no problem, and then right back up the following year, 1 year ago, and then as of today, they're slowly catching up to the 1 year ago value, which they still have a lot more to go, guys, like one more quarter to go to actually get this today value even higher than they were 1 year ago. So for that reason, guys, I'm actually going to give this an even better grade than that of the net income. I'm going to go with like a 90%. And now when it comes to the financial sector, what I've usually found is that a lot of bank related companies, mortgages, that kind of stuff, they usually have a really good shares outstanding, guys. And well, Ally is no exception to this. Take a look at these shares outstanding, consistently decreasing on the 5-year, 437.1 million shares to today, guys, of 312.8 million shares. That is a massive decrease on the 5-year of 28.44%. From the previous year to the current year, it is also down almost 7.5%. Guys, this is looking absolutely incredible. The one time that they actually increased their shares was again during COVID, where 3 years ago it was 374.3 million, and then during COVID it went up to 374.7 million. So small increase right here in their shares outstanding. Aside from that, guys, they're doing amazingly. I'm going to give this metric essentially a 97%. But now let's actually take a look at the assets and the liabilities. And financial companies, once again, are really good when it comes to this. Basically, take the assets, take the liabilities, subtract them, and see what we actually get. If the value of their liabilities is higher than that of their assets, this means that they'll probably go under, guys. However, when it comes to Ally, this is not the case. Now, this isn't a best graph as we just saw with the other ones, but it's still fairly decent. Now, as you can clearly see here, their downturn, guys, was actually 4 years ago, where they actually came down a little bit by around $200 million. 5 years ago, it was $13.49 billion, and then 4 years ago, it was $13.27 billion. But aside from that, guys, it's still looking fairly good. Now, today, they're at almost $14 billion. However, they do still have an entire quarter to go, guys. Maybe they'll be able to get this higher than that of the 1 year ago value, but it still has a big chunk to go, right? At around $3 billion or so. Average total assets is around $179.4 billion. Average liabilities is $165 billion. And doing this difference, we get $14.5 billion. Unfortunately, I can't give this a really high grade because, well, they did have an off year here, guys, and on top of that, I don't think that they'll be able to reach 1 year ago value today, but I'm not going to give it a bad grade. I'm just going to give it a lower grade in the form of a 75%. And now, coming into the part that I'm pretty sure everybody wants to see, and that is the book value per share. We're going to take a look at, guys, the assets the company has on their books and then divide that by the shares outstanding. And this essentially gives us what the company should be worth. Now, looking at this company, guys, today, they're worth $37.28. 5 years ago, they were worth $30.87. This is an increase of 21%. Now, we just went over, guys, what their current share price was. And I will mention this one more time right at the end of the video, but guys, if you remember that share price, take a look at what the book value was 5 years ago and what the share price is today. Yeah, that explains why this is actually a really exciting company right now. And now looking at the tangible book value per share, the same thing as the book value, but instead of taking in all their assets, we actually just take all the tangible assets on their books and then divide that by the shares outstanding. And they're currently at $34.29, so fairly similar to that of the book value per share. 5 years ago, they were at $30.33. That is an increase of 13%. So now let's take a look at the overview of their fundamentals. We got the net income 85%, revenue 90%, shares outstanding 97%, and assets minus liabilities of 75% for an overall grade, guys, of 88%. Absolutely massive banger of a company right here. Oh my god. Now let's find out if maybe doing the price divided by these book values, we can see if it is a very good price today. So now guys, coming into the valuation part. The way that we do this for banks and just financial companies in general is we take a look at something called price divided by the current book value. We just saw the book value and the tangible book value, so let's actually see the price divided by that. And now this ratio gives us essentially whether or not the company is overpriced, underpriced, or at value. At value, guys, is anything with a ratio of 1. Undervalue is lower than 1, and overvalued is over 1. So looking at this price divided by the current book value, guys, we get 0.76, 0.76. Yeah guys, this is looking like a really good company right now based off of their book value. And even with their tangible book value, they're still fairly at a good price. It is a little bit overpriced still, but way under 1 at 0.83. Now the reason why I'm like, oh my god, this is insane, and why I think I actually might put this even higher than Citi is because, guys, we just saw the 5-year book value and the 5-year tangible book value. They are still above the current price of $28.51. So if you were to bring the value of this company 5 years ago to today, it would still be considered an amazing value to buy it at. Granted, these ratios would be a lot closer to 1, but it's still under 1 and it's still looking like a really good value. And on top of that, guys, remember, they do have 5 years of consecutive dividend growth with a massive CAGR of 26.15. So that already there, it's screaming to me that like this company is an amazing screaming buy for both a fundamental basis as well as a dividend perspective. So as you guys can clearly see when it comes to this, guys, this is looking amazing. And, you know, even though this kind of valuation doesn't take into account any assumptions, please still have these calculators. I have this one, the discounted free cash flow, the re-evaluation one, guys, and even a dividend tracking sheet for everybody to have. And this company does pay out a dividend, which means that you guys could use it to essentially track your own dividends for this company. So again, have these calculators, guys. This is not financial advice. Every investment is the present value of all future cash flow. So please make your own assumptions when it comes to the weighted grade for their fundamentals. I gave it an 88. You guys may give it like a 90, 95, or a 50. I don't necessarily know, but you guys should still make your own assumptions and see the fundamentals for yourself, so that way you can make your own judgment. Now, all I'm asking for these free things, guys, daily content, is just one simple thing. It's just, well, just please subscribe to my Patreon. The link is in the description. I am just joking, guys. All of this is for free. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. Really does help here with the algorithm on YouTube. 1,100 people. Oh my god, 1,120 people actually, to be exact. So that is insane. Thank you all so much for all the support. I'm sorry that I've taken a while to cover your guys' suggestions, but you know, you guys had a lot of suggestions, and I also want to do a couple of things that I want to do, right? I've been doing this new mini series of looking at 3 different companies in the 11 sectors that are fair value. Essentially, I'm kind of juggling all these things at once, but I am getting to them when I get to them. So please just be patient with me. I actually might make that list available for everybody, just so that way everybody can see where I am at the current point when it comes to your suggestions. But again, guys, thank you everybody so much for supporting my channel. If you like what I do, all I'm asking for in return, guys, is just like, subscribe, comment. It really does help. So now let's actually take a look at this dividend, guys, because this dividend looks absolutely amazing. Let's say that you make the average monthly US income $5,725, saying that you buy 1 month of this company at the current share price, which is looking amazing to buy right now. You get 200.82 shares, and at the current annual dividends per share of $1.20, this would net you a whopping $240.98, quarterly dividends of $60.24, and a monthly dividend of $20.08. Let's actually make this $2,000 because I am fairly curious, guys, and doing that, this would essentially get you $84.18 in annual dividends, which is not too shabby. Fairly close to where I like to buy it at, which is like $100 per every $2,000 that you invest in a company. So overall, guys, from a dividend perspective, this is looking amazing as well. All in all, when it comes to this company, yeah, guys, this is looking good. Very good. Like, it might even top off Citigroup for me, in my personal opinion. Honestly, I think Citi just hit number 2 on the charts when it comes to, in comparison to this company. So yeah, thank you so much, Gerald Schmidt, for this. again, a really good solid company, and I hope that this analysis helped you and everybody who watched it. If you guys are interested in it, of course, remember, this is not financial advice. That pretty much does it for this video. If you like, comment, subscribe. It really does help over the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, and I'll see you all in the next stock analysis video.